You may have seen the headlines, the blog posts, or the chatter online about a new rule from OSFI, Canada's banking regulator, that seems set to change the playing field and everything for real estate investors. I know there is a lot of confusion out there and, frankly, a lot of anxiety right now. But today we are going past the headlines and the service level panic. We are going to do a deep dive into what this new rule is all about and what it actually means for your ability to qualify for a rental property mortgage and for scaling your portfolio. The details matter, and getting this right is crucial. My name is Dalia Barsoum. I'm the founder of Streetwise Mortgages, Canada's multi-award-winning mortgage brokerage for income property financing. First, let's get the official story straight. OSFI has clarified that this new rule is not a change to the fundamental guidelines for how you, the borrower, get approved for a rental property mortgage. The initial fear that your personal income is now useless, essentially, for buying a rental property is absolutely false. This is a bank capital rule. Essentially, it's an internal classification system for the bank's own accounting. But the real question every real estate investor is asking, what are the unintended consequences of this? How will this actually work in practice? And will it have a real impact on mortgage approvals or mortgage underwriting? To really understand this, let's walk through the critical questions we have been analyzing. The first question is, does this change how your income is treated for the purpose of a rental property mortgage approval? The official answer is no. Lenders already account for your existing mortgages when they calculate your total debt service ratio. In theory, the approval math should not change. But notice my careful use of the word should. As industry analysts have pointed out, you never know how individual lenders will implement the OSFI changes and how will they react. Some may use this as an opportunity to be more conservative, and this is a gray zone. And my team and I will be watching this very closely, and we will keep you posted as we hear directly from the lenders. Number two, how will a bank actually strip out your income? This is the core of this new classification test. Let's run a hypothetical scenario to demonstrate this point. What I am about to share with you is just one way a bank can implement this new policy. Again, every bank will do it in their own way, and we are yet to see how things will unfold over the next few months. But essentially, the core principle is the same. Now, imagine an investor who has a household income of $275,000 and that they own their primary residence and one rental today. And now they're looking to purchase their second rental property. Under this new approach, the lender will first determine how much of that $275,000 is needed to support their current mortgage on their primary residence and existing rental property and their existing debts. And let's say that amount is $220,000. The lender then would determine what is called the residual personal income remaining to service or qualify the new rental property mortgage that this investor is applying for. And in this particular case, the residual personal income is $55,000. That is the $275,000 of total personal income minus the $220,000 required to cover existing mortgages and debt. The lender will then have to determine two things. One, how much rental income the new property generates. And let's say the new rental property is renting for $3,500 a month. That is $42,000 a year. And then two, how much total income does the lender need on the application to actually make this deal work based on their total debt service guidelines? And let's say that number is $60,000. So For this investor to qualify to purchase this second rental property, the lender needs to see $60,000 worth of total income on the application to approve the deal. Up to this point, this is all old news. Actually, nothing has changed. This is part of how things are done today. Here is where the new test kicks in. The lender will now have to compare two numbers to determine whether the approval is highly dependent on the rental income of the property being financed. And that's where they would compare the following. On one hand, they're going to look at the personal residual income they have, and on the other hand, they're going to look at the total income required to get the deal approved. And in this example, the ratio between the $55,000 of residual personal income to the $60,000 required total income is 0.91, meaning that the current personal residual income at hand covers the bulk of the total income required to make this mortgage work. So in this case, this approval is not highly dependent on the rental income of the property. But let's say that the residual personal income is $20,000 instead of the $55,000. Now the ratio between the $20,000 to the total income required to approve the deal of $60,000 is 0.33, meaning that the bulk of the income used to approve the deal in this particular case, which is 67%, the remaining 67% is coming from the rental property itself. And that is where OSFI is asking the lenders to flag this as an income producing asset or an income producing real estate, and is requiring the lenders to set aside a capital reserve in case the worst case situation happens, which is this property being vacant, let's say for an extended period of time, and the investor cannot cover the mortgage from their own resources. That is the caution that OSFI is asking the banks to take on such properties. The threshold that OSFI has set for this test going forward is 50%. So if the ratio of the personal residual income to the total income required to approve the deal, okay, the rental deal is below 50%, then that property will be marked income producing. That's an example of the types of calculations that could take place behind the scene when you apply for a rental property mortgage, when this rule kicks in, whether it's a purchase or a refinance. So what does this all mean for you? While the process of getting approved for a rental property mortgage is not changing, the landscape is. It's not the death of rental portfolios in Canada, but it is a subtle shift. First, deals like the one we just described will now be officially flagged and will likely come with a modest rate premium. The rate premium is expected to be anywhere from 5 to 10 basis points. And second, this gives the big conservative A lenders another reason to tighten up. We might see them, for example, become stricter on the number of rentals that they approve for each client and they want to have on their books per client. As a result, investors who are looking to grow may have to consider a wider range of alternative lending options, whether that's working with a B lender or using strategic commercial financing on residential properties, or navigating the A lender's lending map differently. But here is the most important implication of all. In this more complex environment, strategic financing and deal structuring become extremely important. They become everything. And working with an experienced income property mortgage broker, someone who lives and breathes these guidelines and understands what's happening behind the scene, will be more critical than ever. It will actually be the difference between getting your deal approved and your deal declined, and it could be the difference between getting an A lender deal and getting a more expensive alternative lender option. Navigating these waters is what we do day in and day out, and we are here to help you navigate as well. Most importantly, this new rule comes into effect January 2026. This gives us a clear window of opportunity to lock in financing under the current known guidelines before we see how each individual lender decides to react and potentially tighten their own guidelines. So if you're a real estate investor planning to purchase, refinance, or pull equity in the coming months, having a strategic conversation right now is your Streetwise move. If you want a deep strategic review of your portfolio in light of these new complexities and changes, and you want to map out your next move before these rules kick in and change the landscape, our team at Streetwise Mortgages is here to help you. Click the link in the description to book a confidential complimentary strategy call with one of our Streetwise advisors. Let's get your portfolio prepared. Let's get it optimized. Let's help you respond, not react to these changes. If this video helped you gain clarity, please hit the like button or share the video so other investors can benefit. And as always, stay Streetwise.